Hello, good morning for all viewers. Now I am going to start not-for-profit organizations. Not-for-profit organizations. They are briefly known as NPOs. NPO. So not-for-profit organizations. So not-for-profit organizations means not-for-profit organization means the organization which renders service for the public is known as not-for-profit organization. For example, educational institutions, hospitals, sports clubs, etc. etc. So these organizations are set up mainly to render service to its members in particular and to the society at large. So now let us look at the features of not-for-profit organization. Setup, objective, third one, management committee, fourth one, sources of income, main sources of income, fifth one, books of accounts, type of accounts, next one, nature, next one, entity, specific entity, So these are some of the features of the not-for-profit organization setup. These are set up by persons, organizations in general to serve for the society. Next one, objective. The objective of NPOs is to render service to its members and to the society at large. That means they are not-for-profit organizations. Their main aim is not to earn profit. Their main aim is to render service mainly to its members in particular and to the society at large. Next, management committee. This organization is managed by a committee which is elected by its members. Next, main sources of income. The sources of income are donations, subscriptions, government grants, life membership fees, etc. etc. So these are the some of the sources. Next one, type of accounts. So it are like profitable organizations. They also prepare financial statements like receipts and payments account, income and expenditure account, balance sheet. These are prepared at the end of the year for the purpose of providing information to its members, donors, and also to the register of society. So next one, nature. They are established on charitable basis. Next one, specific entity. They get registered with the societies. Societies Act. So that is why they have specific entity. There is no relation between its members and to the society. So members may come and go, but it continues like a river, like a living river. So that is why it has specific entity having with specific name. So these are some of the features of the not-for-profit organization. Now let us look at the type of accounts to be prepared. Types of accounts. So these organizations prepare the following types of accounts. First one, receipts and payments account. Receipts and payments account. Second one, income and expenditure account. Third one, balance sheet. So these are the financial statements of not-for-profit organization to be prepared at the end of every year. First one, now let us look at one by one the features of receipts and payments account. Features of receipts and payments account. First one, nature of account. Nature. B. Type. C. Debit side. D. Credit side. A, B, C, D. B. Nature of transactions. Nature of transactions. Debit side, credit side. E. Period. F. Opening balance. Opening balance and closing balance. Opening balance. Closing balance. So these are the some of the features of receipts and payments account. So receipts and payments account is prepared at the end of the year. It is a summary of cash transactions. So it is prepared based upon the cash book. So first one is nature. It is a summary of cash book. So it is prepared at the end of the year. It records the following type of, it records both capital transactions, both capital and revenue items. Capital and revenue. Capital means the items which are non-recurring in nature are known as capital items. The items which are recurring in nature are known as revenue items. So it records both capital items and revenue items. Capital items means capital items include both capital receipts and capital payments. Similarly, revenue items include both revenue incomes and revenue expenses. So, capital and revenue items or transactions are recorded in this account. Debit side, all receipts, both capital and revenue, both receipts are shown on the debit side. On the other hand, on the credit side, both capital and revenue expenses are shown on the credit side. Next period, it shows both capital and revenue receipts relating to the previous year, current year and next year. So irrespective of the period, if any of the items either received or paid, if they may pertain to the previous year, current year or next year. So irrespective of the period, irrespective of the capital or revenue, all types of receipts are shown on the debit side. Similarly, credit side, all types of payments are shown both capital and revenue payments are shown on the credit side. Next, period. Irrespective of the period, period means it includes previous year items, current year items, and next year items. Receipts and payments, they may pertaining to the previous year, current year, next year. All these items are shown in this account. Next, opening balance. It starts with the opening balance and ends with the closing balance. Opening balance may be, it refers to the cash in hand and cash at the bank in the beginning. This opening balance is to be shown as the first item on the debit side. Similarly, closing balance of cash in hand, cash at the bank are to be taken to the credit side at the last item, as the last item on the credit side. So after that, this balance must be total. So these are the features of the receipts and payments account. Now let us look at the next type of account, income and expenditure account. Income and expenditure account. So income and expenditure account also one of the accounts to be prepared by the NPOs at the end of the year. It is just like a profit and loss account. It is a generally nominal account. So it shows expenses and incomes relating to the current year only. So expenses are shown on the debit side, whereas incomes are shown on the credit side. The following are the features. First one, no opening balance. Second one, debit side. Third one, credit side. Fourth one, type of items. Fifth one, closing balance. Sixth one, basis. Seventh one, adjustments. So these are some of the features, silent features of income and expenditure account. First one, it does not start with the opening balance. So like profit and loss account, it has two sides. Debit side. On the debit side, revenue expenses are shown, whereas on the credit side, revenue incomes are shown. That means it does not include any capital items in this account, only revenue items. Revenue items means the receipts and payments which are recurring in nature, only shown in this account. Next, type of items. As I stated earlier, it shows only revenue items. Next, closing balance. The closing balance of this account may be surplus or deficit. So surplus also known as excess of income over the expenditure. Surplus arises if the credit side total exceeds the debit side total, then the balancing figure is said to be surplus. So it is also known as excess of income over expenditure. Sometimes it may shows debit balance. Sometimes its debit balance may exceed its credit balance. In such case, the balancing figure is said to be deficit. In such case, the balancing figure is said to be deficit. Next, adjustments. As it is prepared on accrual basis. Accrual basis means irrespective of the paid or received, it takes both in revenue incomes and expenses into this account on the accrual basis, irrespective of the paid or received. It takes both revenue receipts and revenue incomes if they are pertaining to the current year. So that is why it is followed accrual basis. Next one, adjustments. It takes adjustments also. So like non-cash items like depreciation, accrued incomes, so such type of adjustments also taken into this account. So these are some of the features of income and expenditure account. Now let us next statement to be prepared is balance sheet. Balance sheet. So like profitable organizations, NPOs also prepare balance sheet at the end of the year. But sometimes it needs to prepare opening balance sheet also. That is balance sheet in the beginning of the year also required to prepare. Because if the capital fund, also known as general fund, is not given, then to find out the capital fund, a need arises to prepare opening balance sheet. So opening balance sheet format, balance sheet, steps to prepare balance sheet. So first step, assets. Second one, liabilities. Third one, outstanding incomes. Fourth one, prepaid expenses. Next one, incomes received in advance. Next, outstanding expenses. So, first assets. Assets must be taken to the balance sheet has two sides. Their asset side, on the right hand side assets are shown, whereas on the left hand side liabilities are shown. First assets must be taken to the right hand side, that is the asset side. Assets means they may be the fixed assets or current assets. So all assets must be taken after, moreover, assets are to be deducted. If any depreciation is there, if any part of the asset is sold, they must be deducted. The net figure must be shown in the outer column. Similarly, liabilities. If there are liability side starts with the capital fund. For capital fund, some adjustments are to be made. For capital fund, first if there is surplus, that must be added. If there is a deficit, that must be deducted. Along with sometimes legacies, life membership fees, entrance fees, they may also be added to the capital fund. After that, if any outstanding incomes are there, like interest on investments, like that, such type of outstanding incomes are to be shown on the asset side. Similarly, prepaid expenses, if any expenses, salaries, rent, such type of expenses are paid in advance, then such type of expenses are known as prepaid expenses. So they are to be taken to the asset side. Next, incomes received in advance. For example, subscription received in advance. So such type of incomes, if any received in advance, they must be taken to the liability side. Similarly, outstanding expenses. If any expenses are still due, such unpaid expenses are to be shown as liability. So these are the steps to prepare to be followed while preparing balance sheet. Now, let us look at the difference between receipts and payments account and income and expenditure account. Difference between difference between receipts and payments account. Receipts and payments account and income and expenditure account. So difference between R&P means receipts and payments account and income and expenditure account. R&P means receipts and payments account and I&E means income and expenditure account. On the basis of the following, it can be, these two can be distinguished. First one, nature. Second one, type. Third one, nature of transactions. Nature of transactions. Fourth one, period. Fifth one, debit side. Sixth one, credit side. Credit side. Seventh one, non-cash items. Non-cash items. So these are the sum of the differences between receipts and payments account and income and expenditure account. First one, nature. So the nature of receipts and payments account is, it is a summary of all cash transactions during the accounting period, during an accounting period. Next, income and expenditure account is, it is a summary of revenue, expenses and incomes. So second, that is the one of the difference. Second difference, receipts and payments account is a real account because it is prepared on the basis of cash account. So that is why it is said to be real account. Next one, whereas income and expenditure account is said to be a nominal account because it is prepared with the help of the receipts and payments account. So that is another difference. Next one, nature of transactions. In receipts and payments account, both capital as well as revenue transactions are recorded, whereas in income and expenditure account, only revenue transactions are recorded. That is another difference. Next one, period. Receipts and payments account includes the receipts or payments belonging to the previous period and the succeeding period also, along with the current period. Whereas in income and expenditure account, only revenue items belonging to the current year only are recorded here. That is the other difference. Next one, debit side. In receipts and payments account, all receipts are shown, whereas in the income and expenditure account, expenditure is shown on the debit side. That is another difference. Next, credit side. In the receipts and payments account, all payments are shown on the credit side, whereas in income and expenditure account, all incomes, revenue incomes are shown. Next one, non-cash items. In receipts and payments account, as it is prepared on the cash basis, it is prepared. That is one more difference. So non-cash items in the receipts and payments account, no cash items are shown, whereas no non-cash items are shown. Non-cash items means, for example, depreciation, accrued income, outstanding expenses, etc. So these non-cash items are not shown in receipts and payments account, whereas these non-cash items are shown in income and expenditure. Last difference, basis. So the basis to prepare receipts and payments account is cash basis. If the cash is received or paid, then only transactions are recorded in receipts and payments account. In income and expenditure account, it is prepared. Income and expenditure account is prepared on accrual basis. Accrual basis means irrespective of the received or paid, it is recorded. Non-cash, it records unpaid or paid, unpaid transactions also. That means outstanding incomes and expenses also taken into this account. That means receipts and payments account is prepared on cash basis, whereas income and expenditure account is prepared on accrual basis. So these are the sum of the differences between receipts and payments account and income and expenditure account. Now I am going to formats. Format of receipts and payments account. Format of receipts and payments account. So in the receipts and payments account, it is debit side, it is credit side, particulars, the amount in rupees, instead of the particulars, receipts, payments. So on the debit side receipts are shown, whereas on the credit side payments are shown. So it starts with the opening balance. To balance brought down, cash in hand, cash at bank, similarly other cash, other capital and revenue receipts. Similarly, credit side, by balance brought down. In case of overdraft. Similarly, by other capital and revenue payments. So like this, it must be shown. After having shown, it must be balanced. So generally it shows debit balance more. Sometimes, very rarely, its bank balance may be shown as negative also. So if the debit side total is more than the credit side total, then the difference must be, first it must be